Okay, welcome back. In part 7, I'm going to give you a bird view of your new trading process and also an example on US dollar Japanese yen. Today is November 26, 2016, and this is part of the introductory live webinar for session 5 of the FibStalker Methods Coaching Program. Now, as I was preparing here, I answered a question in relation to the typical statistics, like typical risk reward, winning rate, drawdown, whether it depends on the trade. It depends on a number of factors. It depends on the trader. It depends on the time frame you use, the trading system you use, how many markets you look at. And generally, as I mentioned also before, the biggest result have been reported to me by students has been 47 unit of risk in 1 month and 100% return in 1 month. Now, I'm not saying that everybody will reach those. Generally, you have to consider a 70% reliability. You will have 30% of losers, 30-40% of winners. And then you have the remaining break-even as well. With the risk-free approach, you are going to, for 70% of the trade, you're going to be, there's not going to be any pressure on you, because especially at the beginning, I want you to use the risk-free trading approach. Okay, and then he's saying, I really appreciate your time and presentation to help traders like us. Then you're very welcome. As I was saying before, there is a lot of ego boosting around, but I had years and years problems in finding someone who could help me with trading, to find a good mentor. And one of the reasons I do this is to put what I've learned to the service of others, and actually act as a mentor to others, trying to be very realistic about what trading is really about. So I really appreciate that. Looking forward to the other psychology. Brian is saying I have to go now. Okay, not a problem, Brian. I mean, you can watch the recording. Now let's get into this then. Thank you, and let's get into a bird view of the trading process. So, as I showed before, there's a picture here, and this is the process that you will have to master. Now, I'm not going to get into these details. You can see this on the website. What I'm going to do, I'm going to talk directly on the charts here. And there are three main sub-processes. One is the price structure analysis, the other is the price discovery, and the third one is the trading system or trading systems that you apply. So the price structure analysis is basically the analysis of how algorithms are placed on each time frame. And what you do is that you do the analysis on the larger time frames, the weekly, monthly, and then you learn a number of things, levels. You funnel those levels on the smaller time frame, and you repeat the analysis. And then when you finish the analysis, you funnel that back on the larger time frame, and to see what you have learned on the daily, if what you learn on the daily can have impacts on the weekly as well. And you just simply iteratively repeat this process here, and you go down till you are down to the 15 minutes. Okay, now when you do this process, as you do this process, you'll also be able to generate one or more trading plan ideas. Not only that, you will generate also a knowledge about what's going around currently in that market that you will funnel into the price discovery process. And this price discovery process takes the information that you learned from price structure, applies the price discovery rules, applies the FibStalker methods rules, applies the FibStalking timing applied to larger time frames, and applies proprietary patterns. So this process gets as an input, so the knowledge that you get from the price structure, and gets as an input also the trading plan ideas that you developed at the very beginning when you were doing the price structure analysis. The outcome of the price discovery sub-process is that now you have a set of validated plans. This is a subset of the trading plan ideas that you have there. So some of them are gone because you pass them through the price discovery process. It tells you, okay, what can actually happen next. So those validated plans, you don't trade them. You have to filter them again for the last time in the last step of the process to the trading system that you selected. I'll give you 8 trading systems. You can pick one or more and trade them, which means that you will be filtering the validated trading plans that come out from the price structure and price discovery process through your trading system, and that gives you your final trading system. Okay. So this is a very highly structured process. The reason why it's highly structured is that you don't have to do this all the time, but at the beginning you will need to do it like that, because this helps you creating best practices and make sure that you don't lose anything in this process. Okay. So I hope you appreciate that this is part of the studies that I've been doing the last 5 years, basically, putting together everything that I've learned in a very structured way, in a way that anybody, also those who do not have a trading background will be able to do. Now, I want to apply this process to not all of it, but I'm going to do an analysis, because obviously it would take a lot of time to do that, and we will have plenty of time during our coaching program to do that together. Now, as you will remember, I mentioned that, and this is the weekly time frame of the US dollar Japanese yen, I mentioned that we only look at levels identified through Fibonacci level. I'm not going to explain the Fibonacci level to you now. This is going to come in module 1. I'm just going to apply them. And I also mentioned that we look at dump money. Remember, I said dump money, we model it through 13 and 26 EMAs. Well, what you see on the screen is exactly that. The thinner lines are the 13 and 26 for the weekly time frame, which is what you see on the screen here. The larger lines are the monthly levels, the related monthly levels. Okay. Now, before I get into dump money here, let me show you an analysis of Algos. And I won't repeat the full analysis, but I will try to do this in a very, very honest way. And well, I do everything honestly. Otherwise, in this business, there's no future. So so when we look at this market here, sorry, let me remove this. When we look at this market here, at some point we see that this market is very, very extended. And so when we understand this market is very, very extended, we start tracing using some of the rules that you're going to learn in the next module. And these rules, let's say that this market, let's say that 1 week the market had this high here. And so I start tracing from highs to highs, okay? And that gives me this 50% level. As the market keeps moving higher, I keep updating this level, and it's never tested, as you can see, till the point when no new highs, like here, no new highs are printed, and the market starts moving laterally here, and then it prints its new high, and then I have to then update this level. Okay, so I'm showing this to you on a weekly time frame. That is a very, very large. It's a very, very large time frame, but this applies also to shorter time frame as well. Okay, so I keep doing this exercise, and then I discover this day, the next week, that the market printed even a higher high. Okay, so I then have to update this level, and then if that higher high it's never printed again, I keep the level, and this level is very, very important level. Is one level that I will test. Let's look at what happened here in this market, very technical market. The market just gets into that level where algorithms were looking for price, and it jumps. Now, as I mentioned before, we're never gonna buy this level blindly. We will always wait for confirmation, and the FibStalking timing technique is going to be used, and that is going to be introduced in module 3 and 4. But what is important is that every time you have a trace, as you can see, I only use 4 level. The level is 50%, one of the level. The other level is 61.8%, and I use 2 other levels as targets, and these levels are the minus 23.6% and the 61.8% above price. What's the meaning of these levels? It's very simple. It's the 23.6% is the 23.6% of all the trades of this, okay, above the highs, in this case in long. The 61.8% is the 61.8% of this distance here from lows where I traced the extension to the highs here above highs, and this gives me our second target. You can obviously see here that eventually price got into those levels, okay? But there is something more here. Every time we identify in the weekly time frame a participation from algorithms on the weekly time frame, a trend starts if it's tested successfully, and within the trend we can see another trend on the smaller time frame. Okay, so we use all this information in a fractal way because this is something that is going to be used. Now, this market at the beginning here moved laterally, and this called FibStalker sideways pattern, and you will learn about it in section 6, in module 6. But then within it, when the market started moving higher, respecting the 50% level, then what happened is that this market just kept following rules. Now, you don't know the rules yet. You will learn the rules in module 1, the basic rules. But basically, this market went into the first target. The rules are very simple, by the way. There are only 6 rules. And then it retraces back. And when it retraces into another 50% level, which gave us again a first and a second target. And when the market is extended, we have another rule that allows us to capture the extended market. And we trace from highs to new highs. See, even here, so here we trace from lows to highs. We had 1 and 2 weeks before the market got into this level. Okay, I'm not cheating here. I've done this before the fact. I'm just showing you historically what happened. The next measure move 116 came from the highs to highs because the market was extended. This was tested twice, and you can now imagine where the market went. It went to the first target. It didn't go to the second target. It only went to the second target. So once it went to the second target, we actually reapplied the same rules. And again, you will learn all these rules in module 1, and then you'll perfect them and use them as we go. Okay. Now, the market came back, but at this point, we had this level, 117.99, 117.99, 118, and look at what happened to this market. The market actually went into this area. It never broke the 16.14 level, and then it continued higher. Okay, you retested this level because algos were participating here. They were participating also here, but the selling was strong enough to push this price lower within this area. Until we are above 61.8%, the setup is still valid. And however, algos at some point did not support this price any longer. We saw that the 61.8% level was pierced. When that happens, it means that the whole trend higher here has failed. Okay, and now when a trend fails, you will learn that one of the rules that we have is that the trend reverses, and you will learn how. So when the trend reverses, we start looking at this price from the short side of things, and we had the first measure move here that got participation was at 121. By the way, we identified these measurements before the fact, and there are the videos on FX Street on the FX Street Tokyo room at the time when we traded 121 here short. Now, at the same time, there were a lot of people talking about US dollar Japanese yen going to 131, and they were only based on these 2 strong wicks. Where people saw these two strong wicks, they were thinking about higher price. We knew already after the market had broken that 61% level that this market was moving lower. When this market went, well, it went to the first target and initially didn't make it. We took profit at the first target and then it went into the second target. After that, we kept applying exactly the same rule. It's extended. We trace from lows to lows. Before we were tracing from highs to lows. Now it's extended. We trace from lows to lows. Look at where the market stops. It's not a case if the market stops there. And it's not a case the market stops there and then it also there is profit taking at the first target. And so there is profit taking. What do? We keep applying rules here. So we trace again from lows to new lows, and you now imagine what happened next. Well, the market went into that area and right into that area and reversed. Now, every time we identify these levels, we do not trade this level blindly. We always time, which gives us, and that's the reason why our reliability increases as well, because we have these levels, but before we get involved, we make sure that the FibStalking timing is telling us that the algorithms on the larger time frame are stronger than the counter trend algorithms on the smaller time frame, and that's the key of the FibStalking timing. So look at the beauty here. The market goes into the first target, and are you surprised that profit came right at that 61.8% level? Now, these levels are always the same. I never change them, and you can apply them, and you will see them again and again and again working on all high volume markets. Why? Because algorithms are using them, and they are using them to enter the markets, and they're using them to take profits. Now, when we enlarge a little bit this chart, before when this trend was completed, and I mentioned you that the indication for us using the FibStalker methods was here at this level. Can you see that the high was already in place? So this allowed us to do what? This allowed us to trace well before the fact the area where we could get a bounce, and that's was our 170 level. And you should not be surprised that the market bounced at this level. This is a 50% level from lows to highs. Now, when we knew that this was real, we knew that this was real when this trend was failed. And when the trend failed, when we saw this measure move, the next measure move did not work. The next measure move here failed. Failed on top of a 50% valid 50% level watched by smart money. And exactly here, that was the indication that this whole trend down now, before we were going up, now we were going down, was completed. And it's not a case that the market every time retested that 170, it found participation and commitment for traders. Now let's put into the picture, just to conclude this example, the dump money. What we said about the dump money is that the dump money actually obstacles and lags price. So they are reactive, they are not proactive like the smart money. And when the smart money and dump money actually agree, like in this case where the dump money was showing a sell signal here, and I'll tell more about that in the webinars. The market had even a bigger excuse to move lower. There was smart money here plus dump money here. The market moves lower very quickly. And this has happened again a number of times. I'm going to show you some of the examples here, but it's basically every time it happens, if it happens, it's good. Another example is this one. There was smart money coming here at this 50% level, plus there was dump money. It was clearly in selling mode here. and the market moved lower. Now that thing happened in the opposite direction as well, because here now we had smart money with confirmed commitment to push price higher. And look at how changes the behavior, and something that then you have to know, because dump money came in here now and pushed this price lower. But what I told you about that dump money, they can only obstacle price. They don't lead, they don't initiate moves. In fact, only smart money can initiate moves. And so that generated a temporary move, and we have to know these things because we can take advantage of them as well temporarily. But only smart money will tell us when we are on the right track. Okay, so smart money participated again here. Dump money sold again here. Why dump money is selling again here? Because they still believe that this market is going lower. But we knew well in advance, and that's the power of the FibStalking timing, that, and here we knew here. Okay, so we know here, and look at the difference between stalking the smart money and going with the dump money. We knew here that this market was going up eventually. Okay, so that the shorts are low probability because now the path of least resistance is up. We knew this at the beginning of July. Mid of July, end of July, there were still people believing that this market was going down and shorting this market. August, mid of August, there were still people believed that this market was going down and pushing it down. Eventually, every time this market came into the 170 where algos participating, there was always a participation there. So the smart money has proven the dump money wrong here and here. And make no mistake, there were people who were trying to short this also before the US electoral vote. And in fact, we had a move there which didn't make it to 170. Only to discover a few days later that this market was going higher. Okay, so this is a simple application. You will see this again. I could show this on the SP 500, on the other forex, on gold, on silver. It happens all the time, and there are some of these markets that are more technical than others, which means that they respect these moves more frequently than other markets. And you have to also understand what are these markets, because there's no need to trade markets that do not respond well to these moves. Okay. Okay, so this is the example I wanna show you. This just one last question here from Danny. Really sharp edge. Just imagine once then really take place, big winners will take place consecutively. Well, I can tell you that on this, well, yes, when there is enough room, of course. I can tell you, for example, that in this trade here, we timed on a smaller time frame, and there was a 21 reward to risk only on this trade here, and risk adjusted was 11 only on this trade here. Obviously, if there is enough room, and in this case there was enough room because the next area of participation from long weekly was well below, obviously there are multiple opportunities to make money even on retracements as well. So obviously there is a great opportunity and potential as well, and that's the reason why I've been reported 47 unit of risk in 1 month. I mean, that's the reason. Is second position always set to 61.8% or just let it ride the trend until the end while continue to add position? Very good question, Danny. We will get more into the details. What I'll tell you is that, remember before when I said we apply the method not only to identify opportunities for trading, but we apply the method also to frame price. Now, if you let's say you have a second target here, and you leave that market going, and then the market suddenly in 1 week, in few days, retrace against you, can you see that in this case, if you didn't get the profit here, you are going to not get them there unless you remove them as the market is going against you. So generally, the answer to your question is that yes, if I didn't take all my profits on the first target, I will always take all my profits on the second target. And see, I'm not greedy. I have no reason to do that. There'll be another opportunity tomorrow. I'll make that remaining money. So I rather make less money and trade safely than trying to bring my profits um, to levels that I cannot map any longer. When the market becomes emotional like this, I'll show you ways to track and trace these markets as well. Okay, so this is it for today. I hope you appreciate it and you liked this first introduction. I think I'm very excited, to be honest, because I know that there'll be a good portion of you who will end up trading very successfully. It's really up to you. The statistics do not mean anything. In this group, we could have 80%, 100% of successful traders. If it's really only up to you. Okay, the potential is there, so I wanna thank you for the time dedicated today, and I'll send you the information on what you have to do, follow up, and um, uh, and um, we will continue from that. There is Renan asking, could you please put this presentation on YouTube? I don't put material this part of the coaching program on YouTube, Renan. And let me think about this. If you want to have access, maybe I'll create an access for you. Um, if you want to reason around that. Okay, but typically this information is not on YouTube, is in the members area, and that's the only place where you're going to find this information. In fact, as you know, most of you, I think I'm waiting just from some of you, I'm waiting the NDA, the non-disclosure agreement. That's very important. Because clearly this is part of my own research, and I'm not keen and willing to have this information going around. So Renan, let me think about it, and you can. I want to give you an opportunity to review that if you want to. Okay. All right. So Chang, you're very welcome, and I'll see you then. I'll plan for the schedule. I'll share the schedule with you. Thanks for joining, and I'll see you soon. Bye bye now.